Hello, today I am sharing the performance of some holdings in my portfolio for the close on February 27, 2026. I'll show the charts that I use to monitor the technical trading characteristics and what I am observing, along with how they help me form any decisions related to these holdings. In a recent live stream, a viewer asked about when to decide to trim positions. In these weekly videos, I typically share my trim price without much of an explanation about how I determine that price. Today, I will share a bit more detail about how I derive my trim price. We'll begin with the general market overview and company earnings progress so far. And since we are closing out February, I'll update my portfolio returns for 2026. If you enjoy videos like this, please subscribe to the channel and set notifications for future videos. Be sure to press that like button to help support the channel. If you have a comment about any of these holdings, please drop a note so we know what you're thinking. If you have any suggestions about how you derive your trim price, I would like to know that as well. Please leave a comment. Let's get started. Let's get started by looking at the major indexes in a 1-week view. We can see that the equal weight S&P 500 index was the only index to close in the green this week. It was up 0.4%. NASDAQ followed, but it was down 0.2%. The large cap weighted index was down 0.4%, followed by the Dow Jones Transportation Average, which was down 0.75%. The S&P 400 mid-cap index was down 0.88%. The Dow Jones Industrial Average was down over 1%, 1.33%. And the small cap index was down 1.5%, followed by the semiconductor index, which was the worst performer, down nearly 2%. Let's take a look at the year-to-date performance of these indexes as well. So while the semiconductor index was the worst performer in this past week, it is the best performer for year-to-date, up a little over 14%, followed by the Dow Jones up 13.4%, the mid-cap index up 8.17%, small cap index 7.75%, equal weight came in at 6.75%. The Dow Jones was only up 1.9%. The S&P 500 cap weighted index was up about 0.5%. And NASDAQ for the year has been the underperformer at 1.15%. Next, we'll take a look at the sector charts. This is using a 1-week view. We'll also take a look at the year-to-date performance of these sectors. Utilities, consumer staples, healthcare, and energy all led. Utilities was up 3%, consumer staples up 2.4%, healthcare 2.16%, and energy at 1.9%. Communication services was up a little over 1%, followed by materials at 0.85%, and the real estate sector was up 0.64%. Those that lagged were the industrial sector, just slightly below the red line. S&P 500 was down 0.5%. Consumer discretionary was down 0.5%. Technology was down 1.5%, and the financials lagged at a little over 2% down for the week. Utilities is a defensive sector. Consumer staples is defensive. Healthcare is somewhat of a blend between defensive and offensive. It depends on which portion of the healthcare sector you're looking at. Energy tends to be somewhat of a neutral sector. Communication services is aggressive. Materials is neutral. Real estate is defensive. Industrial is aggressive. Consumer discretionary is aggressive. Technology is aggressive. And financials are aggressive. So what we see over this past week is most of the defensive, what I would consider defensive sectors, were leading the markets last week, and those that are considered offensive or aggressive were actually trailing the market overall. So let's take a look at the year to date, and energy is up the most at a little over 25%. Materials 17 and 3/4. Consumer staples up a bit over, or just less than 16%. Industrials up 14%. Utilities 11.8%. Real estate up 8.65%. Healthcare was up about 3.5%. The S&P 500 is up 0.6% overall year to date. That is the SPY, which is a proxy for the S&P 500. Then we have communication services, which is up just less than 0.3%. Consumer discretionary down 2.14%. Technology down 3.62%. And financials has been the lagger year to date at minus 6.1%. This is the S&P in a 1-year daily price chart. And I'm actually going to move in because it'll be a little bit easier to see the activity over the past couple of months where we've just been trading within a range. We had our high back on the 27th of January, so that is acting as a bit of a resistance line. And then we have a support line which was established on the 20th of January, was tested again on the 5th of February, tested intraday on the 17th of February, and we're currently trading just below the midpoint of that trading range. I do see that the 20-day has crossed below the 50-day. That's a bit of a concern. We did have pretty high volume trading on Friday. The RSI on the S&P 500 is just below the midpoint, and the PPO is also trading in bearish territory at the moment. The 5-day moving average of the CBOE options equity only put call ratio is declining, but I noticed on Friday we saw an increase in the raw data where investors were buying more puts than calls, indicating concern of a potential downdraft in the market. So we'll want to keep an eye on this level. It is a bit elevated above the typical 0.55 number that we see. It hasn't been under that since about the 29th of January. If we look at the S&P and the weekly data, we can see that it's currently trading just shy of 60 on the RSI. It is trading above the 20-week moving average, which is upward sloping. We're trading above a 50-week moving average, and the 200-week, which should cover about 5 years. That average is also still moving up, and on the weekly view, we did see above average trading, where the previous week we had below average trading. We do see that the PPO is trending downwards. The money flow is currently positive in the 5-year weekly view. Then when we look at the SPX and look at growth versus defense, so this is the QQQ versus the S&P 500. The QQQ is predominantly growth, where the S&P 500 has some growth components, but not quite as much as the QQQ. But one of the things we've seen over the past several months is a relative unperformance of those growth components. Then the next line is discretionary versus consumer staples, with discretionary being more offensive than defensive. And what we've seen here is also a decrease in the relative performance of those aggressive groups. Then when we look at the Morningstar large cap growth compared to the large cap value, we see a very similar trend where growth is underperforming on a relative basis the large cap value. We see the same with the mid cap growth versus mid cap value. And we see the same in the small caps, where the growth is underperforming on a relative basis the small cap value index. Then when we look at technology, which is aggressive compared to the utilities, which is considered defensive, we also see that same decline, especially in the month of February. Then when we look at the S&P 500 compared to the discretionary versus the staples, we see the S&P 500 has traded relatively flat. But when we look at the relative performance of the XLY, which is the discretionary sector, compared to the staples sector, we see underperformance of the discretionary group. We see that XLY has traded slightly down in an absolute basis, but we see consumer staples have really outperformed since about November of last year. It's the staples that are keeping this S&P 500 line somewhat flat. XLY is detracting from that ever so slightly. So need to be careful, because it's hard to get that S&P 500 moving higher when the defensive groups are somewhat carrying most of the price action. Next, we'll take a look at the VIX. The VIX has been over 20 several times during the month of February. We did drop down to right around 18, which is precautionary. The market is concerned about volatility, and we see that we traded just slightly below the 20 line, which is a line in the sand that's pretty concerning, but we do have the VIX moving a bit higher, and we can see that since the end of December that we have just been on a steady rise in the VIX. So the market is definitely concerned about volatility and what could happen in the upcoming weeks and months. Then, because of the geopolitical events over the weekend, I wanted to take a look at Bitcoin. So we can see that when the attacks in Iran started on Saturday morning, we did see a very sharp decrease in the price on Bitcoin. I'm using this one because it trades 24 hours a day. But what we've seen since is the price of Bitcoin has moved back a little bit higher. So I was concerned Saturday morning when I saw that, what could happen to the market on Monday morning. I'm growing a little bit less concerned based on what I've seen Bitcoin do since we first received those announcements Saturday morning. So we'll have to see what happens on Monday morning when trading begins. It'll certainly be something we'll have to watch. So we're getting close to the end of the earnings reporting season. This is a listing of my equity portfolio portion. And I like to keep track of the earnings and the relative strength, the general trend of the stock going into the earnings. What was the estimate for the revenue, the actual? Did they beat or miss? I do that for earnings as well. I also research the implied move for each of these companies as they move into earnings. I keep track of their short interest, and then I monitor the initial reaction to the earnings, and then 1 week later and 2 weeks later. I only have 2 more companies that are left to report for this quarter. They beat on average the revenue estimates by 1.47%, and they beat by earnings by 13.37%. The overall beat rate on revenue is 86%, and the inline or beat for earnings is right at 70%. And what's been interesting this quarter is despite the 70% meet or beat, the initial reaction was only positive in 30% of the cases. It did increase 1 week later to 45%, and I don't have the full details for all of these 1 week later, nor for 2 weeks later. I won't have those until we get through the CRMD announcement in 2 weeks later. I'll have some finalized numbers on here. So the initial reaction has been pretty poor. Has increased slightly as we moved over time. For each of these, I do put out short videos telling you what the relative strength in the uptrend and the implied move and what the estimates are for revenue and earnings. So if you hold any of these in your portfolio, be sure to watch those shorts, because in 1 minute I give you an explanation of everything that's somewhat important as we move into the earnings release. Okay, so let's get to the charts. We'll start off with Agree Realty, symbol ADC in the 1-year daily price chart. ADC does have a portfolio rank in my portfolio of 8. They are in an overall uptrend. They're actually up 11.73% for the year. On the 17th of February, they did hit a blue sky breakout, so they surpassed their previous all-time high. There are 10 analysts that cover Agree Realty with a 1-year price target of $81.05, with a range between $75 and $84.50. They do have a dividend yield of 3.91%. They have a 5-year dividend growth rate of 1.91%. They are trading above an upward sloping 21-day moving average. They are trading above this upwardly sloping trend line that was set back earlier in the year. They are also trading above an upward sloping 50-day moving average and a 200-day moving average. This is a REIT, so I like to keep track of the 10-year Treasury rate, since REITs are pretty tightly correlated with that rate, because that's what they use to borrow money for their expansion. And we have seen an overall decline in the 10-year Treasury rate, and we can see that the price has reacted positively, and this is a defensive area. So in addition to the 10-year rate going down, we have investors moving more defensively and moving into these REITs. On the 5th of February, I did set a price target of $77 to $78. They actually closed above that target price on February the 13th. We do have an RSI that is slightly overbought, just above 70. We've had a buy signal on them using the PPO since about the 3rd of February, and that does seem to be strengthening. When we look at the weekly chart, we can see that they were up 3.2% for the week. That was an all-time high weekly close. The RSI is sitting at 72 on the weekly chart, and the PPO is in bullish territory, and we can see that they're at a 3-year high for accumulation, and the money flow is currently positive. This is Ares Capital, symbol ARCC, in a 1-year daily price chart. And there has been a lot of discussion recently about private credit concerns. ARCC is a business development company, so it relates to what ARCC is doing. They are down 5.34% for the year, and they're in an overall downtrend. Ares Capital has a book value of $19.94. That's where this cyan colored line is, so I keep that on the chart just so I know what their last reported net asset value was. And I like to buy shares of this company when they are trading below their book value. So back in July through basically October, there was a lot of discussion about the private credit, which drove the cost of ARCC down. And then more recently, TCP Capital, which is a BlackRock fund, reported a 19% reduction in their net asset value because of credit concerns. That reignited the entire credit quality worries. And if you want more details on that, you can look at my ARCC earnings preview video that I posted on February the 4th. Then more recently, there was increased discussion about private credit and the magnitude of the losses. And then Blue Owl Capital restricted withdrawals from one of their private funds, and that led to additional concerns. And then this week there was another credit concern narrative that the risks are increasing, with speculation that defaults could rise to as high as 15% compared to their average of 5%. And that was according to Marathon Asset Management CEO that was interviewed on Bloomberg this week. So these are ones to definitely keep an eye on and see if it spills over into ARCC. It is definitely affecting the company price at the moment, but I haven't heard anything specifically to ARCC. So Friday they had huge volume, and it was a pretty big down day. They closed at 1862 on Friday. They were down 3.42%. They are trading below their 200-day, their 50-day, their 21-day, and all of those are down sloping at the moment. I have this downtrend line, and it looks like they closed Friday below that line. So this is definitely one I'm going to have to keep a close watch on over time to see how these credit concerns realize themselves. I still do like purchasing ARCC when it's below its net asset value. On February the 24th, I did sell 2 puts with a strike price of $18 that expire on March the 20th. So if they close below that price on February the 20th, I'll own a couple hundred more shares of ARCC. If they close above that strike price of $18, I'll get to keep the total premium of $70. ARCC does pay a yield of 10.31%. They have a 5-year dividend growth rate of 3.71%. If we look at their weekly chart over the last 3 years, they did close down 2.77%. Their RSI is below 40. The PPO is in bearish territory, and we have seen a bit of distribution over the past couple of months in ARCC. Next, we'll take a look at Citigroup. They have a portfolio rank of 29. They have a book value per share of $110.01. That's where I have this blue colored cyan line. They have a price to book ratio that is only 1.00, and that is well below the average of the 5 U.S. diversified banks of 1.65 times. It's one of the reasons that at the end of last year I did set a year-end price target for 2026 of $160 to $185. That might be a bit aggressive, but I think that they are underpriced compared to the other 5 diversified banks. This past Friday, the private credit quality concerns came to touch the banks as well. And that was because I guess 2 U.S. banks had underwritten mortgage equities, and there is some alleged fraud associated with those loans to the tune of about $2.5 billion. So it is starting to spill over and become maybe a little bit of a bigger issue. So overall, banks were down, and not just BDCs, but actual banks were down as well on Friday. The 50-day moving average is still moving higher on Citi. The 21-day is actually declining, and the 200-day is moving higher. There was large volume on Friday with credit concerns. They have an RSI of 41, and their PPO has moved into bearish territory. But for the most part, accumulation is still at a 1-year high. Did see a little bit of distribution this week. Year to date, Citigroup is down 5.57%. There are 14 analysts that cover Citi with the 1-year price target of $124.50 and a range between $77 and $150. When we look at them in the weekly view, we can see that they have an RSI of 53. We do have a sell signal as of 20 January, but the accumulation is still at a 3-year high and the money flow is still positive. For the week, Citigroup was down 5.01%. Next, we'll look at CNC in a 1-year daily price chart. They have a portfolio rank of 26 in my portfolio. They had a big downturn last year on the 2nd of July when they pulled their guidance for the full year. They continued to decrease from prices in the 50s and 60s all the way down to $25 in August of last year. Since that point, they have made about a 77% recovery since that August 7th low. They have also transitioned from a consolidation price trend to an uptrend. They have the prices have moved above the 50-day and the 200-day, so we can say that they are in an uptrend. I have a blended intrinsic value using free cash flow of only $20.07. But looking at the valuation using earnings growth, the value is closer to probably $40.89. There are 16 analysts that cover Centene with a 1-year price target of $41.25 with a range between 28 and 61. On February the 17th, I did sell a put with a strike of $38.50, expiring on Friday. That did expire worthless, so I was able to keep the $40 in premium. And now that we're in an uptrend, I will continue to look for opportunities to sell cash secured puts on this particular name. They are actually up year to date 9.06%. They did close up Friday 4.54% on average volume. Their RSI is sitting right around 60. The PPO has moved into bullish territory, and we had a buy signal on about the 18th of February. We look at them in the weekly view. They did close up 3.79%. The RSI is currently sitting at 55, and we are in bullish territory on the weekly view as well. And after a big block of distribution, they have been back in accumulation since about August of last year. When we look at Centene in fast graphs, we can see that they had a big drop in their earnings in 2025 to the tune of 71%. They are expected to return to growth this year and the two subsequent years, 45% for this year, 36% growth in 2027, according to the analyst, and 59% for 2028. So they are trading above their normal market multiple and their fair value currently, but if they are able to pull off this earnings growth that the analysts expect, they will be doing fairly well over the next 2 or 3 years. They do have an EPS yield of 4.96%. They have grown their operating earnings growth rate at 11.85%. That gives them a fair value ratio of 15 times, and their normal PE is 15.14 times. Next, we'll look at Entergy. They're an electricity provider with the symbol ETR. They are currently trading at all-time highs. ETR has a portfolio rank of 5 in my portfolio. They are in an overall uptrend. And on February the 9th, let's see, right here, they actually broke above their all-time high, so they are in blue sky territory at the moment. Friday was definitely an all-time high. They closed up 1.31%. They're at 15.88% for the year. They do pay a dividend of 2.39%, and they have a 5-year dividend growth rate of 5.7%. There are 15 analysts that cover ETR with a 1-year price target of $104.73 and a price range between $93 and $119. They are overbought according to the RSI, and the PPO is positive and looks to be getting stronger as we move forward. We look at them in the weekly view. They're also setting an all-time high in the weekly view. They are overbought in the weekly view, and the PPO seems to be getting stronger, and money flow is positive. If we look at Entergy and fast graphs, we can see that they are very extended above their normal market multiple. The blue line and their fair value is calculated by Entergy, which is the orange line. They are expected to grow their earnings 13% this year, 12% for 2027, and 11% for 2028. They have an EPS yield of 3.72%, a dividend yield of 2.39%. They've grown their earnings at 4.73% over this time frame. Fast Graphs calculates their fair value at 15 times, and their normal market multiple is 16.25 times. I have 2 or 3 charts where I'm going to talk a little bit more about my trim points and how I establish those. So I use chandelier exits, and the current value on the chandelier exit is 101.3. If we look at where my orange line is, I currently have it setting at 100.82 because that's where the chandelier exit was set last week. The price has moved up. The chandelier exit takes the average true range, so it takes volatility in consideration. It looks at the average true range over the last 22 days, gives me that average, and I have a multiplier of 3, and that is where I set my trim level. So I can see just by watching, and I've removed all of the other lines so you could really focus on this chandelier exit. But you can actually see that it dipped here, and then it's been moving higher as the price has moved higher. So now that the chandelier exit has moved higher, I want to move my orange line to that level. So 101.3. So I'll just change that to 101.3. And now my stop loss or my trim level is set to that value. So I'm not trying to catch the top on here. I don't know where the top is going to be. But if these prices start rolling over, the chandelier exit is going to start moving down, but I don't move my orange line. So it's set to a high water mark at that point. But if these prices start rolling back over and they drop below my trim level, that's when I start to take some profits and start reducing my position size. I don't necessarily try to catch the tops. I also have a multiplier value of 3. If I wanted to be more aggressive, then I could decrease that, and that would move the chandelier exit a bit higher. But I don't necessarily try to catch the tops. I am a little conservative there, so if it starts to decrease, I don't get stopped out early. But if it does get to this level, I will consider trimming the portfolio size on this particular holding. So that's how I use chandelier exits. And what the orange line represents, that always represents the high water mark of the average true range over the last 22 days. This is Genmab in the 1-year daily price chart. This is a biotech company, and I had first bought into them back in October, a couple of times, a small holding. I ended up selling out in end of December because I was looking at the seasonality, which I'll show you here in just a few moments, and notice that the first quarter is one of their weakest quarters of the year. And it first appeared that that was probably a very foolish decision because they did climb from that $30 up to $35, but it finally kicked in, and we're down to about $29.44 as of today. So as we're moving back into a more seasonally strong part of the year for Genmab, I have begun to re-add shares, and I'll continue growing this one over the next couple of weeks to a month. So there are 6 analysts that cover Genmab with a 1-year price target of $41.08 and a range between 34 and 48. Year to date, they are down 4.42%. I do have a trim point set on this holding at $28.11. So if this recovery doesn't take place as I anticipate, if it drops below that, then I'll probably exit the position. So let's look at the seasonality. We're looking at 7 years, excluding the current year. And the reason I sold out is because January, February, and March are seasonally weak periods of the month. They only end the month higher 17% of the time in January, 33% of the time in February, and it's a flip of the coin for March. But as we move to April, 67% of the time they end the month higher than they started the month, and the typical performance is 5.6%. The next 2 months are 50%, and with the typical performance of 3% and 0.6%. But then when we get to July, over the past 7 years, they've had a 7.2% increase 100% of the time for July. So selling out for the first quarter so far has been a good choice. I'm starting to add back in because the next 4 or 5 months from a seasonal perspective are very strong for Genmab. They do have an RSI that is below 40, so they're not oversold and they are moving higher. The PPO has been negative and in bearish territory, but it looks to me like we are going to get a bullish crossover in bearish territory very soon. If we look at the accumulation, we're at a 52-week high. If we move to the weekly chart, they were only up about 0.5%. The RSI is just below 50, so it's slightly in bearish territory. We did get a sell signal on them at the end of October, and that continues up until this point. Over this 3-year time frame, the accumulation was at a peak during the 3rd week of January of this year. They have been on a slight decline distribution, but this past week we did see a bit of accumulation. So I think this is a good time to be entering into Genmab. If we look at Genmab on fast graphs, they're trading just below their fair value. Their earnings are expected to contract this year at 25%, but they are expected to return to growth in 2027 and 2028, with a 53% growth in 2027 and 41% in 2028. They do have an EPS yield of 5.01%. Their earnings growth rate over this time frame is 21.91%. Their fair value is calculated at 21.91 times, and their normal market multiple is 43.08. This is Hess Midstream in a daily 1-year price chart. They have a portfolio rank of 9 in my portfolio. I have a blended intrinsic value on Hess at $47.31. They are in an accumulation price trend. Friday, they did close at a 65-day swing high. They do pay a dividend of 7.9%, and they have a 5-year dividend growth rate of 11.05%. Year to date, they are up 12.12%. There are 7 analysts that cover Hess Midstream with a 1-year price target of $41.43 and a range between $36 and $48. They are trading above a 21-day upward sloping moving average. The 50-day is below the 200, but it is moving up, and I expect it to cross above the 200. So that's what puts them into accumulation trend at this moment. When once the 50-day gets above the 200, then we would consider it an uptrend. The RSI is in overbought condition. We've had a buy signal on this one since about the 13th of January, and the PPO is looking very strong at the moment. Back in September the 10th, UBS had downgraded them on Chevron, pulling back one of the rigs, and so that warning was out. And then on the 19th of September, that rig count was reduced from 4 to 3. It was reduced by 1, not 2-1. It was by 1. So I had trimmed some of my shares on the UBS warning. I'm thankful that I did, because they had a 10% price drop on the 19th. I started picking back up shares and have bought a couple more times as recently as this past week, because I do expect them, with energy prices expected to continue increasing this year, that Hess could be a good performer. When we look at them in the weekly view, they hit a 13-week swing high. They were up 2.08%. The RSI is not in overbought condition on the weekly view, and we had a buy signal on them in the weekly view at the beginning of December. Money flow is about as strong as it's been over the last 3 years. Accumulation is also back to a 3-year high. We look at Hess Midstream in fast graphs. We can see that they are trading under their fair value calculation and also their normal market multiple. They have an EPS yield of 7.41%. They've grown their earnings by 13.58% per year. They have a fair value calculation at 15 times and a normal market multiple of 15.41. They are expected to grow their earnings 2% this year, 9% the following year, and 3% in 2028. I have traded Hess Midstream several times since I first purchased it in June of 2024. I made a total of 32 trades. 24 of them are open, 8 are closed. 30 have been winning trades, 2 are losing trades. For my winning trades, I've averaged $231 per winning trade, while keeping my losses to only $37.50 for those 2 losing trades on average. That gives me a win rate of 94% and a gain to loss ratio of 5.34 to 1. Next, we'll take a look at Hershey, symbol HSY, in the 1-year daily price chart. We can see that they are trading at all-time highs as well. They have a portfolio rank of 28 in my portfolio. They are in an overall uptrend. Year to date, they are up 29.84%. I have a blended intrinsic value on Hershey of $202.99. That's where the blue cyan colored line is. There are 15 analysts that cover Hershey with a 1-year price target of $212.67. with a range between $185 and $283. They have a dividend yield of 2.46 and a 5-year dividend growth rate of 11.8%. One of Hershey's primary inputs is the price of cocoa. So we can see that the market was anticipating, based on cocoa future prices, that they would have a downturn in the price, and they certainly did. We can see the price of cocoa reached a price of about $12,000 per ton, dropped down to about $7,500 per ton, back up to the $12,000, and since that time has gotten back down to what could be considered an average price of cocoa. So that has helped the price of Hershey's overall move higher, along with the market moving more defensively. If we go back to the 1-year price chart, they are trading above an upward sloping 21-day moving average, an upward sloping 50-day, and an upward sloping 200. They are in an overbought condition, and the PPO is still in bullish territory, and it looks like accumulation is at a 1-year high. So we have an interesting case here related to my trim point. So my current trim point is $220.23. But notice that they just paid a dividend. So the Chandelier exit takes that into consideration. And because I've had some returned capital on this holding, I get to reduce my trim point. So I'm actually going to reduce that to $218.65. So I can enter that value here. And when we go back to the chart, you'll see that my orange line has moved down slightly. And that's to compensate for the dividend that's been returned to me. If we look at them in the weekly chart, they are up 6.54% for the week. I think I said on the 1-year chart that they were traded at all-time highs. That's not true. It's a 52-week high. So they're also trading at a 52-week high in the weekly view. They are still overbought even in the weekly view, and the PPO is in bullish territory. The accumulation hasn't quite got to the level that we saw back in 2023, but we do see a bit of accumulation, and the money flow is positive. This is Hershey in fast graphs. We can see that they somewhat agree with the blended intrinsic value that I have, that it's currently trading above its fair value and its intrinsic value, and even above its normal market multiple. That was with an earnings decline in 2025, but they are returning to growth in the future 3 years. They have an EPS yield of 2.81, a dividend yield of 2.46. They've grown their earnings growth rate at 7.69. Their fair value is 15 times, and their normal market multiple is 23.57. But I do think Hershey is a bit extended above their intrinsic value. This is Johnson & Johnson, symbol J&J, in a 1-year daily price chart. And they've been on quite a run since their breakout in July. This is actually an all-time high. They were up 2.04% on Friday. My trim point is going to be raised. It's currently at 237.56, so I need to update that. Last week it was 235.36, so I can now change this to 237.56, and we can see that my trim level has moved up a bit. So basically what will happen is if it trades down below this orange line, which is set to that high water mark, then I will consider doing some trimming. Currently, they are trading above an upward sloping 21-day, 50-day, and 200-day, and they are priced above what I have calculated as an intrinsic value of $184.86. There are 17 analysts that cover J&J with an average price target of $227.29, with a range between $153 and $265. Year to date, they are up 20.04%. They do pay a dividend yield of 2.09%, and they have a 5-year dividend growth rate of 5.18%. If we move to the weekly chart, we can see that they've closed the week up 2.99%, which was an all-time weekly high close. They have been in an overbought condition since the 11th of August of last year, and they've pretty much been on a buy signal since the 30th of June. Over this 3-year period, the accumulation is at a 3-year high, and the money flow continues to be positive. Next, we'll look at Altria, symbol MO in the 1-year daily price chart. This is also a consumer staple stock, so it's finding some strength in this move towards defense. I've held this one for a while. It has a portfolio rank of 4 in my portfolio. It is in an overall uptrend. I have a blended intrinsic value on them of $73.65. On February the 5th, I did identify a price target of $72.50, basically based on this cup with handle that fired on the 4th of February. Wednesday, they did close at an all-time high. They are up year-to-date 19.74%. They do pay a dividend with a 6.14% yield. They have a 5-year dividend growth rate of 4.12%. There are 8 analysts that cover Altria with a 1-year price target of $62.76 and a range between $50 and $72. This is one where I can see that the candelier exit has moved higher, so I'll adjust that one live for you. Last week it was $64.28, and this week it is $66.50. So you can see that the chandelier exit is $66.50, so that's what I just set it to. And when I click the screen here, we should see that orange line move just a little bit higher. So it is $65.50 at the moment. So that becomes my new trim level. If this one rolls over and starts moving back down, then that's where I would look to be exiting some of my position and reducing risk. If we go to the weekly chart, we can see that they also closed at an all-time high in the weekly view. They are a bit overbought. The PPO is in bullish territory, and money flow is still positive at the moment. When we look at Altria in fast graphs, we can see that they're trading below their normal market multiple. They've been trading below that for quite some time, since about 2019. They are also trading above their fair value as calculated by fast graphs. They have a very good EPS yield of 7.9%. They pay that dividend with a yield of 6.14. They have an earnings growth rate of 6.10 over this 13-year time frame. They have a fair value ratio of 15 times, and their normal market multiple is 12.89 times. They do grow, a slow grower, but they do grow their earnings. 4% is expected for 2026, 3% for 2027, and 4% for 2028. This is NNN. They are a REIT. They have a portfolio rank of 12th in my portfolio. They are in an uptrend. They did touch an all-time high intraday on February the 17th, and once again on February the 27th, Friday. The all-time high is annotated with this dark blue line, so it hasn't closed above that all-time high yet. They are up year to date 14.36%. 6 analysts cover NNN with a 1-year price target of $43.33 and a range between $43 and $44. They do pay a dividend of 5.3% and have a 5-year dividend growth rate of 2.78. They are trading above an upward sloping 21-day moving average, an upward sloping 50-day moving average, and an upward sloping 200-day moving average. And once again, because this is a REIT, I keep the 10-year Treasury rate on here. You can see that the 10-year has been dropping since about the 4th of February. That helps with the valuation, so the prices tend to increase on REITs when that 10-year Treasury rate goes down. However, there's also a defensive quality to REITs. So as investors are looking for a bit of safety in this turmoil, they find a home in NNN. When we look at Fast Graphs, we can see that they're trading below their fair value as calculated by Fast Graphs, and they're trading below their normal market multiple. They have a very good AFFO yield of 7.63%. They do pay that dividend at 5.3%. They've grown their AFFO over this time frame on an average of 3.94%. Their fair value is calculated at 15 times, and their normal PE is 15.86 times. REITs tend to grow slowly, so they're expecting 3% growth in 26, 3% growth in 2027, and 2% growth in 2028. This is Realty Income. They are also a REIT with the symbol O. They're a monthly dividend payer, and they are also trading at all-time highs. They had a breakout on February 4th above their all-time high, so they're in a blue sky breakout. Also on that date, I set a price target of $67 to $68, and that was based on this cup with handle. And on Friday, February the 27th, the close was exactly at that lower price level. So they closed at 67, and my low target range was also 67. They are trading above an upward sloping 21-day, 50-day, and 200-day. Once again, this is a REIT, so I keep an eye on that 10-year Treasury rate. We had 2x volume on Friday. They are in an overbought condition. The PPO is bullish at the moment, and after some distribution, basically back in December, they started an accumulation, and the money flow is currently positive. My trim point is 64.85. Last week it was 63.78. They are up year to date 18.66%. They do pay a dividend of 5.24%, and they have a 5-year dividend growth rate of 3.53%. There are 12 analysts that cover Realty Income with a 1-year price target of $64.83 with a range between $60 and $70. They're also hitting all-time highs in the weekly view. They are also overbought in the weekly view. PPO is bullish. Looks like the accumulation is at a 3-year high, and the money flow is currently positive. They were up 1.71% for the week. We look at Realty Income in Fast Graphs. We can see that they're trading slightly above their fair value calculation, which is at 15 times. They've grown their AFFO by 4.46% every year on average. They have an AFFO yield of 6.42%. and that dividend at 4.84%. This is a REIT, so they tend to grow slowly, and basically they're expected to grow 3% over the next 3 years. This is Pultegroup, symbol PHM, and this is a 2-year daily price chart. And the reason I have it for 2 years is there is a cup with handle that formed. It appears to be breaking down here, but we did get the signal to fire on about the 13th of February. So given that condition, we take the price at the right rim of the cup, which was $141, or subtract the low, which was $87, and then add that back to this price, and that gives us a target of $192. So that may be a challenge for this one to get to that price, but there are some talks about improving home affordability and providing more homes in the entry level market. So this is a small position that I just started, and I'm going to be growing that over time. There are 12 analysts that cover Pulte with a 1-year price target of $137.67, which is basically where they're currently trading. The range of the analysts are between $98 and $159. Pulte is 8% below their all-time high close on 18 October of 2025. A close above that level would confirm a blue sky breakout. They do pay a small dividend with a yield of 0.75, and they have a 5-year dividend growth rate of 12.97%. This week they did on one day, maybe a couple of days, traded right below or right at their 21-day moving average. They did manage on Friday to close above that 21-day moving average. The 50-day moving average is trending higher along with the 200-day moving average. I did add a few more shares at $137.65 this week. They do have an RSI that's in bullish territory. The PPO is also in bullish territory, but we did get a bearish crossover on that this week. And the accumulation over this 2-year period is at a 2-year high. The money flow is currently bullish as well. When we look at them in the weekly view over 3 years, they were down 2.01% for the week. The RSI is right at the 60 level. We have a buy signal in the weekly view, and that has triggered on about the 26th of January. And we can see that on accumulation, we're at a 3-year high, and the money flow is positive. When we look at fast graphs, they are trading slightly above their normal market multiple, but trading below their fair value is calculated by fast graphs. Over this 13-year period, they have never traded above their fair value. That fair value is calculated at 19.17 times. Their normal market multiple is 9.37 times. They have a very good EPS yield of 8%, and the dividend yield at 0.76%. Their earnings are expected to contract this year by 8%, but return to growth in 2027 at 12%, and 2028, 17%. I was asked by a viewer to review Prudential to see if they were in a good buy zone. So we're going to look at them in the 1-year daily view. This is one that I've owned for a few years. Their book value is, adjusted book value is just above 100. They did close on Friday at 98.38, so they are trading below their book value. My average cost per share is about $95, so I'm just below where it's currently trading. I'll show you my trades here shortly. They have been on a downturn in the first quarter. The fourth quarter tends to be their best quarter. We'll look at them in the seasonality here in just a moment. Financials overall took a hit on Friday, although I don't think Prudential was directly involved in what drove the financials down. I talked about the fraud in that one loan in the UK, or those loans in the UK, which tended to hit all the financials. But Prudential, I don't think, would be affected by that directly. So I think this was probably an overreaction because they were down 3.84% on that day. That's a pretty big decline for Prudential. That was on about 2x volume. The RSI is below the 40 line, currently sitting at 35. The PPO is in bearish territory as well. Personally, I think this would be a good buy just based on my own trading history, since it is below its fair market value. It has traded below that, but it rarely stays below that value for very long. They are in a distribution trend pattern. Year to date, they are down 12.85%. That book value is $100.17 for the adjusted value, and the raw value is $92.05. They did complete $250 million worth of buybacks in Q4 of 2025, and they have a share repurchase authorization of $1 billion for 2026. So if we look at Prudential in the seasonality chart, we're looking at 13 years here. We're excluding this past year. And we can see that the first quarter tends to be weak for Prudential. They end the month higher in January, only 69% of the time. And that average return is minus 0.3%. In February, it's 0.2%. March, it's typically down 2.1%. But then April, May, June, July, we're up 2.9% on average, 69% of the time. 1.1%, 54% of the time. Up 1.2, 54% of the time, and in July, it's 3.4%, 77% of the time. And then in a seasonality perspective, August and September are typically weak, and then the fourth quarter tends to be the best quarter for Prudential. But this next quarter is expected to be a little better from a seasonality perspective. So I'll be looking for an opportunity to probably pick up some shares early next week, possibly on Monday. I'll go overweight in this position, and I'll wait for a recovery to trim some of those shares and get back to equal weight. There are 10 analysts that cover Prudential with an average price target of $115.70. and a range between $103 and $127. They do pay a dividend of 5.69%, and they have a 5-year dividend growth rate of 4.18%. If we look at them in the weekly view, they did drop 4.89%. I think that's a little overdone. I don't think the news that happened last week was directly related to Prudential in any way. They do have an RSI in the weekly view that's getting close to 40. The PPO is in negative territory as I would expect in the first quarter. The accumulation still seems to be pretty strong, and the money flow is currently still bullish. If we look at them in fast graphs, we can see that they're trading below their normal market multiple and fair market value. They have an excellent EPS yield of 14.63%. They are supposed to have a contraction in their earnings of only 1% this year, but return to growth in 2027 with 9%, and 2028 would be 7%. So I think there's a good opportunity to pick up some shares and get a good return over the next possibly 3 years. Finally, we'll take a look at WP Carey, symbol WPC, in the 1-year daily price chart. They are in an overall uptrend at the moment. Their Friday close was up 0.54%, which was an all-time high. I do have a trim point of 70.64, so let's go adjust that live. So last week it was 70.42, so I'm going to raise my stop loss up to 71.64. So now we have a new stop loss level. They are trading above an upward sloping 21, 50, and 200-day moving average. Once again, this is a REIT, so I keep an eye on those U.S. Treasury 10-year yields. They do have an RSI that's currently at 67, and the PPO is in bullish territory, and the accumulation is at a near 52-week high. There was a slight bit of distribution this past week, and the money flow is also positive. Year to date, they are up 15.99%. They do pay a dividend yield of 4.93%, and they have a growth rate of negative 2.38% because they spun off their office buildings and reduced into a separate company, and they reduced their dividend accordingly. There are 8 analysts that cover WP Carey with a 1-year price target of $70.75 and a range between $66 and $74. We look at the weekly view. They're also trading at all-time highs in the weekly view. They were up 3.14% for the week. Their RSI is moving into overbought territory, and their PPO has been on a buy signal in the weekly view since the beginning of January. And in the weekly view, we can see that accumulation is at a 3-year high, and the money flow is positive. WP Carey in fast graphs, they have an AFFO yield of 6.7%. They have a dividend yield of 4.93%. And over this 13-year period, they've grown their AFFO by only 1.05%. Their fair value is calculated at 10.6%, and their normal price to AFFO is 13.3%. Now, over the next 3 years, they are expected to grow their earnings by 4% in 2026, 3% in 2027, and 5% in 2028. But it looks like they are priced above what would be considered fair value in their normal market multiple. They have done that several times in the past, and each time they've traded too high, they did have a pretty significant pullback. So this will be, I own 5 REITs altogether. This will be one that I will probably eliminate once I start seeing the price roll over and get to my trim point. That'll actually be become a portfolio exit at that point for WP Carey. If you found this video helpful, please remember to subscribe to the channel and set your notifications so you'll be reminded of future videos. Be sure to press the like button to help support the channel. And remember, if you have a comment about how to improve this process, please drop a note. If you have any questions, please drop that in the notes as well, because I respond to those pretty quickly. I wish you the best in your investment journey, and remember to trade well. We'll talk again soon.